So it's an all lawyer day here. And today's event is a presentation about a discussion about competitive investment landscape in the digital market, the global competition for those investments, and particularly by sovereign wealth funds, pension funds, and specifically the competition and the activity US and China. So the other two lawyers, the two speakers today are Winston Ma and Paul Downs. I'll let them introduce themselves a little bit. You should know that each of them are authors, lawyers, law professors at different times, and but for today's purposes, they are experts on the investment, the global investment in chasing digital investments around the world. And so what we're going to do is the presentation will probably be about 25 minutes. We'll have the Q&A afterwards. And it'll probably go for about 1 hour. We can go over that a little bit if we have outstanding questions. So if you have questions along the way, please put them in the Q&A box, and we will pull them out and try to aggregate them and make that go as efficiently as possible. So I think without any further delay, why don't I introduce Winston? Maybe you want to start off, introduce yourself, and maybe Paul, and then you guys go into your presentation.
Sure. Thank you, Donald and Michelle. Very briefly, I was native Chinese, but spent last 2 decades in the cross-border U.S.-China scenes, right? I was educated both in China and the U.S. I went to Fudan University in Shanghai, and then I came to NYU for Master Law, and U Michigan for MBA during that time. And before my 10 years at CIC, China's Sovereign Wealth Fund, most recently, I had 10 years on Wall Street, first as a securities lawyer at Davis Polk, and then later as investment banker at JP Morgan and briefly at Barcap. So I got to the US training for CIC work. So to me, today's topic is really about how we find a way to make this cross-border opportunities continue for people among all of us. Paul?
Good morning. Thank you, Don. Thank you, Michelle. Thanks to the Hong Kong Association of New York. It's a pleasure to be addressing this group this morning. My name is Paul Downs. As with everyone else you see on the screen, I'm a lawyer. I practiced for decades in New York, focusing on cross-border transactions, investment transactions involving the United States and other countries, as well as third country transactions. In the last several decades, the area of focus has been sovereign investment funds. And as I got more involved in representing them in transactions and regulatory matters, it became evident to me that they were important, powerful players that were little known or little understood, even by the people that serve them in investment banks, law firms, and other consultants. And so it occurred to Winston that it was a good idea to write a book about this, and it's a fascinating story. I think you'll enjoy it if you crack the tome, and tells the many interesting stories that are behind the headlines. So with that, I'll turn it over to Winston. We can get into the topics.
Great. So let me share the screen for the presentation. All good? Yep.
Now it is, yes.
Okay, great. So here is the background of today's topic. The 2 books that I recently put together. The Hunt for Unicorns, which I co-authored with Paul Downs, is about sovereign funds from over the world: China, Singapore, Middle East, even Canadian pensions, all getting into the game of tech investing. They become the new venture capitalists. And another book, The Digital War, published at the same time, relates to China and the US specifically, about these 2 tech superpowers decoupling from each other and entering into a tech competition. And then you say, well, what's the connection between these 2 books? You could say that the US-China tech war leads these governments into the hunt for unicorns. And here, a bit of definition here. Unicorn in the context of tech investing means private company that has a valuation more than $1 billion. And the hunt can mean acquire the tech startup or means killing the unicorn. Depends which side you're sitting in. And today this is the story we're gonna focus on. Now, a bit of background, right? When we say sovereign funds, what are they? Obviously, many people here must have heard about CIC, and it's a kind of sovereign wealth fund. It manages a portion of the government wealth for the future of the nation. And there's also government pension fund, which manages the pension money for the citizens. And the third category is the central banks. Like in the China context, it's the SAFE of PBOC, and for Hong Kong, it's the Hong Kong Monetary Authority, right? But either way, they manage the reserve of the country, and they manage the currency fluctuation. And during that process, they make global investments to manage that money. But the punchline is, globally, when you look at these three groups across all the continents, there are more than $3 trillion in assets under management by this group called sovereign funds. And the largest one is the Norwegian fund, by definition, because it manages the oil money of that country. But next page we will see, there's a lot of different kinds of sovereign funds. So here, you look at the top 10 sovereign funds. Very interestingly, China has three. China has three, and they represent the three categories. As I said, the CIC, which I used to work at, is a sovereign wealth fund. The National Council for Social Security Fund is for the pension of the citizens. And a SAFE, right, is part of the central bank. It makes global investing, but most importantly, it is the creditor to the US because it holds more than $1 trillion of US government bonds. So to some extent, it is even bigger than the Norwegian fund, which is the largest sovereign wealth fund. Now, interestingly, right, Hong Kong Monetary Authority is more than $500 billion. It's one of the top 10. So Hong Kong really is a big player in this. And then next to this group is the pension fund top 10. Now, interestingly, the biggest one is the Social Security Trust Funds. Since it's a Hong Kong, so it's in New York, I'm pretty sure many of us, right, have some interest in that one. But you may ask, like, why we never heard of them investing in capital markets? And the answer is different investment strategies. When we see the sovereign funds in headlines like CIC, like Singapore sovereign funds, Temasek, very famous, right? They are busy deal makers. But for some sovereign funds, like the Social Security Trust Funds, are very passive. They allocate money into money managers. They mostly buy public stocks, so they're not really kind of in the deal making. This difference in investment strategy and investment style is very important as we think about the story of the hunt for unicorns. Now, what we saw when we start seeing these sovereign funds become active, interestingly, it was during the last crisis. 2008, during the financial crisis, lots of the Wall Street banks got into trouble. And funny enough, it was these sovereign funds from the emerging markets coming to rescue. So in the case of Citibank, it got money from the two Singapore sovereign funds, Temasek and GIC, as well as two Middle East sovereign funds, the RDA of UAE and the Kuwait of KIA of Kuwait. And at that time, CIC was also set up. That's where my career at CIC started. CIC was set up end of 2007. I moved back beginning of 2008. And one of the early deals CIC did was the investment into U.S. Wall Street as well. Very first deal was $3 billion investment in one transaction into Blackstone's IPO, summer of 2007. And then several months after that, the financial crisis became more and more serious. Morgan Stanley got trouble. So end of 2007, CIC put in about $7 billion in one transaction into Morgan Stanley, which literally rescued that bank from collapsing. So when I'm looking back, right, I think those are really good old days. Obviously, if you can see the card number of my POS at CIC. I was among the one of the first 100 employees at CIC. Very early, lots of cash to deploy, great fun. And because I was one of the few guys stayed through the first 5 years, I got my CIC watch. Yeah, good old days. But it is, I call it the good old days, also because that was the best time for deal making, because the U.S. financial system was in crisis. The capital market at that time had no liquidity, right? So that provided great opportunity for new sovereign funds like a CIC to put money to work and take a significant stake in U.S. Wall Street banks. And later, as we have seen last couple of years, right, this cross-border flow is now under challenge because there are more regulations of these cross-border investments, for which Paul will address more at his section. But that was really the good old days that started this rush into direct investing by sovereign funds, and it sort of emboldened the sovereign funds to become more active, more direct, to be the deal makers instead of giving money to Blackstone. Let Blackstone to be the deal maker. Anyway, so now the front line is digital sector, right? Last crisis, the sovereign fund started investing in the financial services. Now the frontier is to invest in tech, because this is the future of global economy. The best example, obviously, is the Vision Fund. It's a 100 billion VC fund, which is never heard of. Just to put this into context, if you talk to a Silicon Valley VC fund, most likely its size is about 100 million or even less. So we're talking about a new VC fund that's 1,000 times bigger than a typical VC fund. So of course it's changing the game of unicorn hunting. Why they got so much money? That's because two sovereign funds in the Middle East, so Saudi Arabia PIF and Mubadala of UAE. Yeah, they put more than $60 billion into this Vision Fund, which is run by SoftBank Masayoshi-san. We have seen lots of headlines there, including they're investing into Tesla, investing into Uber, Airbnb recently IPO'd was also a successful example of Vision Fund. Of course, they also had WeWork, which is a disaster, right? So, by any event, right, they creating unicorns in different way as compared to a typical sovereign fund, typical VC fund. Another example is the rising of Chinese unicorns thanks to these sovereign funds. Yeah, when you look at Ant Financial, the financial arm of Alibaba, it is, even though its IPO was suspended a few months ago, but it is still the largest unicorn in the world, with 150 billion valuation from 2018 financing. Now it's interesting to see how many sovereign funds were involved in Ant. Of course, the CIC, Social Security Fund of China, was the early investors of Ant Financial. But in later rounds, in more recent rounds, almost all the global sovereign funds got involved in it, right? You have the Singapore Temasek GIC, you have Malaysia Khazanah, you have Vision Fund. We just talked about the mostly Middle Eastern money, and then you also have CPPIB, the Canadian pension. Canadian CPPIB, by the way, is also a $500 billion entity. But the punchline of this chart is, the several things. One, these guys have huge checkbook, right? So when they write a check, they make unicorns. And secondly, Silicon Valley used to be where the unicorns are, but new places are coming up as the innovation hubs, like China in this example, right? And Hong Kong, to some extent, is also part of this ecosystem. And and extend that, Southeast Asia becomes another innovation hub as we talk. So we will see more and more sovereign funds going into China, going to Hong Kong, going to Southeast Asia, as we see more innovation power coming from the East, while the Silicon Valley remains an important innovation center of the world. Now, what's the connection with the digital war? Is now we see sovereign capital going in a new angle as this new venture capitalist, which is to finance research and investment so that the country to be self-reliant in key technologies. And the best example of this is semiconductor and China, right? Because as we have seen in the context of Huawei sanction, China is still in need of US chip supplies. So not surprisingly, China set up a semiconductor fund, which is about $30 billion, whose mission specifically is to invest in the chip industry so that China can have an independent supply chain of chips, independent from the US, right? Otherwise, it's always in the danger of being sanctioned in some way. Now, the example of this is SMIC. It's a Semiconductor Manufacturing Investment Corporation. It is listed in Hong Kong, and it has the China Semiconductor Sovereign Fund investment. So I use this as the example to close my section, and then I turn to Paul. Now, why SMIC Semiconductor is interesting. Now, first, it was listed in New York. 2019, it voluntarily chose to delist from New York Stock Exchange. Maybe it was anticipating some tech war to come. So anyway, so they delisted, but they kept their Hong Kong listings so that global investors can still access SMIC stock from the Hong Kong market. A few months later, May 2020, they got the investment, more than $2 billion investment from China's semiconductor fund. And in July 2020, it got listed in Shanghai Stock Board, right? This kind of the China's NASDAQ board. And it had a tremendous valuation jump. So far, so good. So far, so good. But of course, the tech war, as we talk about this digital war today, right? The tech war kicking in. The funding from the China Semiconductor was revealed on the same day that US announced sanction on Huawei. So of course, this SMIC company was viewed as an alternative supply chain to Huawei. So the US starting to take action. September 2020, US Commerce put SMIC on sanction list that impacts the company to acquire American technology for SMIC production. And December 2020, the Defense Department puts the company on another sanction list. And this is a sanction about stock investing. I refer this as the stock ban. When Defense Department puts the company on a blacklist for deemed military ties with China, it prohibits US capital from investing in that stock. So even for the Hong Kong listed stock, the US institutions must sell within a time period. So maybe because of all this, the co-CEO of the company resigned in December. Maybe not only because of the capital flow, right, but also from the technology flow, since the US sanction seriously impacts its ability to source American technology for its production. And January 2021, we started to see MSIC, S&P, and many index-related products starting to remove SMIC from their indexes, which includes the Hong Kong-listed SMIC stock. So the impact on the stock is very serious, right? Since its July peak, just like 6 months ago, the stock has lost, about half of its value on stock change. So I conclude my section with this is saying, the sovereign funds have become the new capitalists. They can create unicorns, but at the same time, their involvement also triggers other countries' actions, especially this China-US tech war. And it's not just President Trump, trying to get some headlines. Actually, the impact is real. Like for SMIC, its stock price almost got chopped into half during the last 6 months. So we'll see lots of these regulatory implications coming up. So I turn this to Paul.
Thanks, Winston.
Thanks very much, Winston. You've depicted the arc of the transformation of these sovereign investors from passive to active, from investing in the financial sector to investing in the digital sector. And I will cover the reaction that this has engendered in the United States once the politicians as well as the government woke up to what was happening, how US has reshaped its national security system to address this perceived threat, but how other elements have been brought in and have had some collateral damage in places including Hong Kong, and how the US and other countries are moving into a more regional approach, which will be of interest to, I think, our Hong Kong audience. So first, let me start out with just the overall point, which is, I think Winston finished on this, that this is not simply a Trump idea. The pivot in the United States to viewing digital investments as national security issues really started before Trump. And it has received bipartisan support. Back in 2018, the Committee on Foreign Investment in the US, which is the primary government entity which reviews foreign direct investment for national security risk, was given much wider powers, mandatory filing powers, among other things. And the remit was extended beyond traditional national security elements such as missile technology and nuclear power to very broadly and vaguely defined areas, including, that you'll see on the screen, critical technology, whatever that is, critical infrastructure, which maybe is a little clearer when we're talking about server farms and internet access and so forth, and then sensitive personal data, which hardly seems a national security issue, but as you'll see in the following slides, has become a real focus of the US government in terms of national security risk and review of foreign direct investment. First, let's have a little bit of history. If we can go to the next slide, Winston. The CFIUS, the Committee on Foreign Investment in the United States, is an agency that started out back in the Ford administration, believe it or not, as a very informal part of the executive branch, which was set up really to depoliticize the review of foreign direct investment in the US. The US at the time had devalued the dollar and was interested in getting foreign direct investment. And the system gradually became more formalized, more codified, and more focused on preventing foreign direct investment in the United States. It gave the president the power finally to block deals. That power was used not just by Trump, although if you look at this list, you'll see at the bottom he dominates it, but also by Obama a couple of times and by Bush. And bear in mind that these are only the deals that went through the entire process without deal fatigue. More frequently, someone who considers investing in the United States runs into the CFIUS review process, will simply withdraw. And interestingly, what is highlighted there in 2017, here we're going into details on it, there was an attempted investment by a Chinese venture capital group into a US lattice semiconductor, a US semiconductor business. The reason we point this one out is that the transaction was run through Yatai Capital Limited, a Hong Kong-based company, notwithstanding the fact that the Hong Kong investor was the principal investor in the fund which ultimately sought to acquire the US semiconductor business, kind of the core of national security in the digital area. The US government, CFIUS in this instance, looked through Hong Kong and said, well, really the party in interest are the Chinese venture capital fund, China Venture Capital Fund Limited, which is the Chinese investor, and therefore the National Security Review ended up with a blockage by the president of the transaction. Go to the next slide. We'll see, there we go. We'll see that Hong Kong will feel increasingly the impact of CFIUS going forward with the Trump administration's decision to review the status of Hong Kong. It doesn't really change fundamentally the activities of CFIUS, although CFIUS is, as we see in the lower bullet point, has expanded its scope of review substantially, and therefore more potential investments run through Hong Kong will be impacted. But in addition, the Hong Kong companies were already subject to review to the extent that there was a further upstream investor from China. Here we have a slide which talks a little bit about the personal digital information, which is actually an interesting area, and financial, which we saw earlier in the slide, the world's largest unicorn, attempted for more than a year to acquire a US remittance business, MoneyGram, and was simply stalled, and finally the parties gave up, realizing that the Committee on Foreign Investment in the United States, CFIUS, would never approve the transaction. It eventually came out that the reasoning behind it was that this transaction would enable Ant Financial to obtain access to personal digital information of all the users of MoneyGram services, mostly foreign residents of the United States, principally Mexico. That's the largest channel, who were sending money home. Nonetheless, that was of concern. Grindr, TikTok, you know about. Grindr is a gay dating app, which, to the surprise of the Chinese acquirer, was deemed a national security risk when acquired. It was later subject to a divestment order. And TikTok, as you probably know, has been much in the headlines. The musical video app has become a focus of the Trump, became a focus of the Trump administration, and a divestment was ordered, and then a deal was put together, and then was put on ice. And we'll see where the Biden administration heads with this one, but I think we should expect more activity here. So not enough that it's CFIUS that looks into all these deals. The Trump administration elevated to a new status something called Team Telecom. Team Telecom has been around a long time. You see here its principal components: the Department of Justice, Department of Defense, Department of Homeland Security, and the FBI, who advise the US telecoms regulators about national security risks in connection with investments and transactions in this sector. This directly has impacted Hong Kong, as we'll see from the next slide. Google and Facebook were planning on, and eventually built, an undersea cable from Los Angeles to East Asia. The idea was to land it, among other places, in Hong Kong, in addition to the Philippines and Taiwan, departed from Los Angeles. A minority investor in the consortium that has constructed and laid the cable was a Chinese-controlled entity. For this reason, Team Telecom ultimately, after hemming and hawing for a long time, came to the decision that the connection should not be authorized directly between the US and Hong Kong, and therefore this major infrastructure transaction will land in the Philippines and Taiwan and never be turned on in Hong Kong. Other ways the US has responded are more regional in nature. The US is setting up, or has talked about setting up, various sovereign funds of its own, along the lines of what Winston was talking about with the SMIC initiative, where funds will be set up to fund 5G, which seems to be playing out as the next round of digital hegemony, digital conflict between the US and China. There's also something called the Development Finance Corporation, which is banded together with other countries, many in East Asia or the Eastern Pacific, to foster development of the digital infrastructure in places outside the United States. We go to the next slide. You can see the Development Finance Corporation again here is showed joining up with Japan and Australia, and potentially with India, to set up something called the Blue Dot Network, which is really positioning itself as a counterweight to the Belt and Road Initiative. And there will be a large focus in this funding organization in East Asia. So Hong Kong will be surrounded by these activities, as well as suffering some of the consequences, and as Winston pointed out, enjoying some of the benefits by listings there. But if you want to know more, we'll go to the final slide. You can read the books. Between them, the United States and China have more than 80% of the world's unicorns. And so Hong Kong is well positioned in the middle of this exciting development. Thanks so much. We now have questions.
Yeah, Winston and Paul, great. So thank you so much for that. And so I see a few questions coming in, a few questions for myself. I mean, I would encourage everybody to read these books and other books on this topic and really get to know and understand this, because this type of thing is not slowing down. It's not going away. It may be a little bit unfamiliar to some people because many of these big investments are kind of together with private equity. They're maybe not always listed companies. They may not always be names you know about, but they're incredibly important. And the issue of security, cybersecurity, digital data management, these things, I mean, they just sort of multiply almost every day, it seems like, right? And the threat then, I mean, there's so many levels of interesting issues here. So some of these funds invest just as funds. They just invest sort of neutrally. They may be limited by their governments for what they can invest in, but they're just looking for returns. Others are looking to support national champions and bring, like Mubadala, would, for example, like to bring intellectual property and jobs and manufacturing to the UAE. But its sister organization, Abu Dhabi Investment Authority, invests for the long run. Almost, sometimes they're influenced by the government and policy and so on, but mostly not. But the national security implications for everybody are massive, and this is driving a lot of these decisions, including with CFIUS. I mean, just today there was an article about the water supply in Pinellas, Florida, and it was hacked. I don't know when, last week or two, or probably a year ago, who knows? And to add more of a certain type of important chemical into the water, which is important in small amounts and deadly in big amounts, and things like the electric grid and all that. So that's why this data is just unbelievably important. But I think a lot of people just sort of miss it because they also miss it in their personal lives. They don't seem to care that Facebook, Google, and everybody takes all their data, and they're willing to make this trade-off. And so we're kind of just sort of in this naive ignorance about the importance of all this stuff, right? And so one of the things I thought was really interesting is the Social Security Administration's balance of funds, I guess you might say. I happen to know the guy who heads it up, Andrew Saul, and I've never thought to ask him what his investment mandate is, because you never hear about them investing in anything. And that's because they don't invest like sovereign wealth funds. They invest almost a little bit like Abu Dhabi Investment Authority, but even more quietly and even more through the indexes and all of that, right? Whereas state funds like CalPERS and all that, they're in the news all the time, and they're investing strategically, but let's say on a higher risk level as well. So many of these funds, they just have different mandates, different levels of transparency, different purposes. So I guess one of the questions I had, and I'll pull another question I see online, is these funds, some of these funds are definitely investing in unicorns, but they're also making unicorns. And is there too much money chasing too few deals? And WeWorks is a great example of that, right? Of SoftBank investing, creating a new value, investing again, creating a new value, and then it comes tumbling down. How much risk is there in this sort of unicorn and sovereign wealth fund system? And obviously SoftBank's not really a sovereign wealth fund, but they kind of compete like one. How much risk is there in the overvaluation of some of these industries and companies?
I'll let Winston start on that one.
Yeah, I can start. You know, I think you're absolutely right that because of the large ticket size of the sovereign funds investments, the sovereign funds are not only hunting for unicorns, but they are also making the unicorns, right? Because if you write a 100 million or more equity check, most likely, you know, after the post money, the startup will become a unicorn, right? So I think the reason for that is also related to the setup of the sovereign funds and their investment style. You see, Donald, for many of the sovereign funds, they're just starting to become venture capitalists, right? Traditionally, they're just like a social security fund, passive allocator, let external managers to chase the unicorns. Now they say we're going to do it ourselves. But they have very few people, right? Especially for the state pensions, low budget. So they just have a few people, right? And even for CIC, large team, still early. So naturally, they become the venture capitalists of the later stage. When the startups are very close to a unicorn status, and they say, okay, we're very happy to put a 100 million check there, right? Donald, consider this as a kind of a problem that these $30 trillion guys have. They want the startup to be big enough so they can write a big enough check to move the needle. So what they're doing is they go into later stage of startups after traditional VC funds investments. They push up the valuation, and certainly that leads to the discussion of overvaluation, Donald. Now, interestingly, how do the sovereign funds react to this? They say, you know what? The risk is not, the valuation risk is there. And instead of not investing, let me invest early. That's what they do. So they say, like by investing early, like the traditional venture capitalists, maybe I can manage my risk better because I can go in at this earlier valuation and I can get involved with the company more instead of just like a WeWork, right? Got in really late and then the founder was out of control and then everything tumbles. Paul?
Yeah, I think those are all good points. I would just add a few things in response to what Donald was saying. I think there's a coupling of the growth of the unicorns and their power and their ability to use our data and so forth that relates to the fact that they're not going public. They're not subject to the scrutiny of public markets. They are subject to the scrutiny of a small number of large investors who, as Winston points out, are not heavily staffed and tend to be on the whole rather secretive. When I was practicing, I would have clients in this sector that would say, no, you can't announce the transaction. You can't even say that you represent us publicly. They don't want the profile often in their home country because they're making massive investments abroad and don't want to be subject to public review and scrutiny. So this mix of factors has generated a huge explosion in the size of unicorns and the venture capital markets, as Winston points out, and maybe overvaluation, but keeping in mind that I think with SoftBank yesterday announced $11 billion increase in valuation as a result of its early investments, mostly backed by sovereign venture capital. So, who are we to judge?
Right. So again, I think it's partly what the mandate is, right? So, for example, there are definitely some sovereign wealth funds who are investing for kind of vanity purposes to promote how advanced their country is, right? And why did the UAE, why did IPIC invest in Manchester United? IPIC's pretty much gone now. It's folded back into Mubadala because of the 1MBD scandal, and all those things are just kind of a little bit out of control. And I worked on some of those things, and it just seemed like this endless pile of money and deal making, and then somebody a little bit higher up said, no, that's it, it's over, we're going to fold it over here, right?
Yeah, the 1MDB case, Donald, is a good reminder that the sovereign funds need good lawyers, right?
Yeah, and probably good corporate governance.
When you have $30 trillion.
Good corporate governance and some oversight would probably be helpful as well. So let's see, we got a couple comments coming in. Peter Chang says, is there a way to pre-qualify target companies which would not be under CFIUS control or review? So Paul, that's probably more your question. And of course, CFIUS is really interesting to me. I've done a number of CFIUS deals and investments in the US and port deals. And what's really interesting is CFIUS really has almost very limited, almost no court review of their activities. they can give all the sort of outlines of how they act and why they act, but they can basically do whatever the hell they want to do. And only the president can override a negative decision. He can't override a positive decision, right? So, and so the 2018 amendments are really pretty strong. We'll see how they get implemented, but they really expanded CFIUS as a scope because people were moving around them doing leases for real estate, which weren't really covered, but they were actually controlling companies and being in important locations. So again, the question is there a way to pre-qualify target company which would not be under CFIUS control or review? There's probably 10 different questions there.
Yeah, unfortunately, CFIUS does not give advisory opinions. They will tell you to go away. There has evolved a system where counsel will prepare sort of a preliminary submission and talk to CFIUS, and you might get an indication that, oh, we're not really interested in this, bottling plant in Iowa. But I wouldn't count on it happening, and it's hard to know where the Biden administration is going. The really bad news, however, is that CFIUS has recently ramped up its enforcement capability. They've hired nearly 100 people in enforcement in recent times, and are scrutinizing after the fact investments. We talked about Grindr, we talked about TikTok. So even if you talk to counsel and are convinced that your social media dance investment is probably not a national security risk, that may not turn out to be true. So I'm sorry it's bad news, but I can just say, talk to counsel who's familiar with dealing with CFIUS. They can give you the best guess on this.
Yeah. Thanks, Paul. You reminded me that I actually need to submit the letter of recommendation for my NYU student to DC today. Yeah, because there's a lot of job openings there. CFIUS. Actually, one of the students, in my class, as I'm teaching over there, asking me for my recommendation, to say he's interested in the class. He can be a good lawyer for the CFIUS and the related agencies in DC. Clearly, that scope is expanding. Back to you.
There's a career path.
Yeah,
yeah, I mean, it really is, and I suppose if they're going to have a wider scope, they ought to do what their mandate is. Because before, they basically, 20, 30 years ago, almost no deals were ever under scrutiny, and certainly very few deals were ever canceled, right? Now, it's the amendments, there are actually mandatory filings, which in certain categories, in certain segments, primarily national security and things, and that I can only imagine that category is going to get bigger and bigger and bigger. And there's going to be a lot of mandatory filings and reviews. Because one of the last things you want to do as a deal maker, a lawyer, a banker, whatever, is do a deal and then have to unwind it because CFIUS comes knocking at your door, right? So most deals, of course, have a CFIUS unwind provision in them now that are of a certain size or a certain sector.
Right, and there's an important, I think, chilling effect at work here, Donald, where people say, oh, I don't even want to think about it. And I've worked with sovereign funds that are setting up consortiums to do deals, and they'll look around at who the other bidders are, and they'll say, well, they won't get anywhere with CFIUS, so we don't have to top their bid, or we don't want them in our consortium because it might impact our chances at CFIUS, and it affects the calculus in countless ways.
Yeah, and there's no doubt that the amendments and the implementation of it relate to a policy of excluding parts of the world and including other parts of the world. So there's I think there's 5 countries that already have passes on these mandatory categories. The UK, your sort of typical maybe Five Eyes countries are going to get a pass. Then maybe the UAE and a few others sneak in, and they get pretty nice treatment. But Russia, anything in the Eastern Europe, China, clearly, you don't even have to talk about North Korea because they're never going to invest in anything in the United States, or at least not knowingly. So in this, I think that scrutiny is only going to grow. So
that's interesting. A year or so ago, I asked a senior Australian government official about what they felt about this sort of Five Eyes exclusive group, and he said we could never get away with that in Australia. We could never take an approach where there was a wait list and a blacklist. It just wouldn't be possible, but the U.S. can.
Right, that's a whole nother conversation. Many people don't even know what the Five Eyes are. It's basically English-speaking countries of the U.S., Canada, UK, New Zealand, and Australia. And basically since 1946, they've been listening to every piece of communication in the entire world that they can get their hands on, and they still do. And that was pretty much through and exclusive to that group until almost the mid 2000s, early 2000s, and then a lot of other countries start getting this capability, right? I mean, if you think, you know, it's not even clear whether Google, Facebook, or governments are more sort of at risk from a libertarian perspective of your information and your knowledge. But let me tell you, they know everything about you already. So another question has come in from Wendy Liu. How do you think the relationship of US tech companies and China tech companies in the near future? Do you think they could work together or just basically become competitors? So yeah, the sort of market access and collaboration between US and Chinese companies.
Yeah, really great question. Really great question. Because, you know, I think first of all, the decoupling is really happening and accelerating, right? As we talked about, China wants to be self-reliant on chips, and the US wants to have alternative 5G technology to Huawei. And the latest is that the Clubhouse app is already being blocked by China, right? You know, it got popular in China for a few days and now it's blocked. So the decoupling is really happening, but the US-China ecosystem connections actually is more resilient, more profound than that. Again, in the case of Clubhouse, right? Actually, the Clubhouse platform is built on the technology from a Chinese company. These guys, the founders of this Chinese company are the former founders of YY, also Hong Kong listed, was like the Grindr for everyone. You know, it's a dating app for everyone. Now, it's interesting that they provide that technology support, and according to rumors, that Clubhouse was built up within a week based on this company's technology. And also interestingly, you know, this Chinese company is also listed in New York Stock Exchange, in NASDAQ. It's called Agora. So when you look at all these, right, you know, there are a lot of interconnection between US tech companies and the Chinese counterparts. And when they work together, you know, they generate very good products, right, like Clubhouse. And I would even say, you know, when they have the competition, they can also lead to very good things, especially when they compete at each other's market, right? So for example, TikTok is one of the few Chinese companies that managed to have a substantial presence in the US. And because of TikTok, it forced Facebook to learn about the new features from the China market, especially on short videos, such that Facebook improves its features. Yeah. So I think, you know, if we see more collaboration, more competition from the tech companies across the Pacific, all are good things. You know, what's really kind of a challenge in this thing, or in Paul's earlier words, the chilling effect, right, is the government involvement that try to artificially cut that tie. So I think to conclude, right, I think, you know, the connection is very resilient. You know, the China and US are the two most important innovation centers, and the cross flow of capital, talents, and the transactions are always there. There's a lot of challenges there, but you know, hopefully this new Biden administration will start a new dialogue. So we may look for a new equilibrium such that we can keep the business going, right? You know, this is what Hong Kong people most care. You know, just keep the business going. Yeah, Paul.
Oh, Paul, you're on mute. Yeah, let me unmute. So I think those are all excellent points, and I will just keep it brief to add. I think one of the I talked about the chilling effect of CFIUS earlier, and a part of that is the unpredictability. And I think the unpredictability index went to extreme highs during the Trump administration. And I do think one of the goals of the Biden administration is to lower the unpredictability index so that business can go forward. There may be restrictions, there may be concerns, there may be constraints, but perhaps you can chart a path if you know what they are and can rely upon them. So I think that, to Winston, your point, that there is a close and very fundamental interrelationship between the US and Chinese tech markets. I mean, look at Microsoft, look at LinkedIn, part of Microsoft, look at Tesla. So there are there are many examples in this area. And I think those companies will pave the way for the possibility for greater integration between the two in certain areas where the governments are not going to interfere.
So I think it's interesting that, you know, the questions like, well, why would somebody be interested in a dating app, or list 100 other seemingly innocuous sort of social interactive things. I think technology, the advancement of technology itself has made the potential risk of those investments to the other government even bigger. So for example, I'd say like 20 years ago, the idea of China or anybody else having access to personal information on a dating app would seem like, well, that's ridiculous. That can't be worth their time to find something. Well, now data management and manipulation is so easy. It's like, well, let's just grab all that data. We might find one guy we can expose, and he's got a problem over there, right? It's kind of like the Chinese version or US version of Russian compromat. Just collect things on people, someday we might use it against them. And I think that's an increasing concern, and why even things like dating apps that don't really tie into the national grid or national security are sort of easy things to just try to access and get data out of. And
great point, Donald.
And we can manage data, we can scour data. You know, it's not like 9/11 now, where it took a year to figure out all the communications, and oops, we missed that one. That's why that happened.
Right.
It all can be kind of done and increasingly so easily and affordably. And so everybody's trying to capture everybody's data. Simple as that, right?
That's true. That's true.
Yeah.
You know, everyone wants to capture other people's data. Everyone wants to protect its own data. So that's where the tension is.
Yeah.
And Hong Kong maybe is the middle ground for that.
And the data is becoming more sophisticated and more useful. I think one of the things about Grindr was that its geolocation services were so excellent that it was easy to determine what US troops who were on Grindr, where they were and where they were assembling. So I think there's stuff behind this that is not apparent that has real significance.
So even issues of like, I do a lot of transportation work, there's a potential investment in the US rail car industry. Well, it's like, oh, why would that be a danger? Well, in case of national emergency, you start moving resources and people around. When rail cars start moving around and you're tracking that data, you have some insight about what the US might be doing from a national security perspective and from a defensive perspective. So everything has so many multiple layers to it, and it can be overblown, obviously, but everybody's concerned on both ends of all kinds of transactions of national security data. So on the idea, and maybe we'll finish on this, unless somebody else has another question, they can add it to the chat room, is in sort of from the perspective of this potential dividing up between the world based on these issues, is there pressure on some of the other sovereign wealth funds? Like, will the US put pressure on the Norwegian fund or Temasek and others not to invest in a deal with a Chinese fund? Or is that happening?
I mean, one thing I'm seeing is that some of the smarter funds are playing both sides. If you look at some of the slides, you'll see that the Singaporean funds in particular are looking to invest both in China and in the US. And as Singapore, they're not really getting any pushback on that. I don't think the Norwegians need to be dissuaded from taking investments in other parts of the world. They're very conservative investors, and so I don't see them doing things. The question of whether the Canadians might feel some pressure is an interesting one. I haven't heard them say anything about that. They probably wouldn't talk about it. And again, the sort of the cone of silence descends over these funds too frequently. That's an interesting point. We'll see where that one plays out.
Yeah, several very complex legal questions here, right? One is U.S. put on this stock ban for some of the Chinese tech companies, right? Like the SMIC listed in Hong Kong. So of course, CalPERS, these U.S. pension funds have to follow this order. They have to divest.
Yeah, right. Otherwise, you'll have sanctions on them, and then they can't
stock
trade
if they have, right?
Can't trade in
But
dollars.
Paul mentioned about Canadian pensions, right? So Canadian pensions, they already have a huge amount of U.S. assets, right? So the question is, with this, their massive U.S. holdings make them subject to U.S. government sanctions? That would be interesting, right? And if you push this argument further, then what about CIC? CIC has a significant ownership in U.S. bank, Morgan Stanley. Does this make, and of course, make tens of billions, hundreds of billions actually, of assets in the U.S. right? Does this make CIC subject to U.S. regulations as well? And it'll be kind of ironic if CIC has to divest investments in Chinese stocks. But these are questions for good lawyers.
Yeah.
Right, and I haven't talked to the Hong Kong Monetary Authority about this, but I'm sure they have reams of people studying exactly these issues, because it's hard to think of a sovereign wealth fund that is more exposed to both sides than the HKMA.
Right. So then, let's see, there's a couple more. Oh, no questions, just excellent discussion. Wendy said she enjoyed it, and she sent LinkedIn invites to all of us. So you can look on your LinkedIn. I guess maybe my final point is, traditionally, the U.S. government does not have a sovereign wealth fund per se. And for investments, or you might say political persuasions. Now, the CIA might form a technology company, and you don't know that that's actually owned by the government. That's a little bit different thing, right? But the Development Financial Corporation has the prospect of, transition from being a sort of a lender and insurer in developing or frontier locations to being an actual investor, and basically telling developing companies and frontier companies, don't take the Chinese investment. We have $60 billion now. We'll invest in you. We'll invest in this company, right? Do you see that the DFC may, do you see it playing a role yet in certain investments? And do you think it's going to be funded with more than $60 billion and be like a real player in the future?
I think that the Trump administration certainly saw it that way. It was really viewed in some respects as an answer to the Belt and Road initiative. It was viewed as a way to compete with Huawei's dominance, particularly in telecoms in Africa. Whether the Trump administration and Congress will go along with additional funding remains to be seen, but it is interesting that the US has taken the fund approach as a point of departure, not having done it in the past.
Great. Well, so we're a little bit past our time. We've taken care of all of our questions. If you guys have any final comments, they'd be welcome. And if not, we want to tell everybody who's attended that we have thank you for joining us. Thank you to Paul and Winston, and also thank you for Michelle for working hard to put this together. We have another event coming up. I believe it's on the 17th. We'll let everybody know about that. And it's an interesting discussion about another lawyer. So that's like all lawyers all the time out of Hong Kong, who's dealt with fraudulent personal protective equipment that was ordered from the US. And he kind of gives this whole story about the dangers of and the difficulties of that, and the Homeland Security and the Border Patrol stopped it, and the investment stuck in the middle, and then there's a big lawsuit in Hong Kong. So that's our next event. Again, Paul, Winston, thank you so much for participating. Hopefully we'll see you at a few other future events of ours, and we hope everybody has a great day.
Thank you very much, Donald. It was a pleasure.
Thank you very much. Take care.
Thank you. Bye-bye.
Bye.